Hello everyone. So I'm going to go over practice problems from chapter 13. So let's start with the first one here. A stock just paid a dividend of $2 per share. So as I mentioned during the lecture, the language here is important. The stock just paid a dividend, so that means this is the current dividend. So this would be D0. And then you have the beta of the stock, risk-free rate, and market risk premium. So you have all the information for CAPM to compute the required rate of return. And you have to determine the value of the stock in the no growth case and in the constant growth of 3% case. Okay, so let's first start with computation of uh, the required rate of return. Okay, K. So CAPM is K equals risk-free rate plus the beta of the stock times market risk premium. Right, market risk premium is market return minus the risk-free rate. Right, so for this problem we have the risk-free rate of 3%. Risk-free rate is 3%, beta of the stock is 1.3, and we have the market risk premium as 6%. So again, remember, risk premium is where the risk-free rate is already subtracted out. So this would be 10.8%. All right, so that's the required rate of return. And then for the no growth case, if you recall from our lecture, this is the no growth case. The valuation is simply, so this is just a perpetuity, the constant dividend paid forever. So the present value of perpetuity, that's the value here, the dividend amount divided by the required rate of return, right? So for our question here, the dividend amount is, let's see, the dividend amount is $2 per share, and we just computed the K as 10.8%. So under the no growth case, value is 2 divided by 10.8% or 0.108, and that would be 18.52. Okay, and then we have the constant growth of 3% scenario. So here we assume that dividends would grow at the fixed rate of 3% forever. So the model there is D1 over K minus G, right? D1 over K minus G, or we can also write this as D0 times 1 plus G over K minus G, and we'll be using this equation since we know D0. Okay, so D0 is so what's the value in this case? So D0 is $2 per share times 1 plus G, so that is 1.03. Growth rate is 3% over K minus G, so K is 10.8% minus 0.03, right? So that would be the constant growth valuation, and that is 26.41, right? So that's $26.41. All right, so that's the first problem. Okay, moving on to the second problem. So here again we have to do valuation and also need to compute the present value of growth opportunities, that is our PVGO, and the PE ratio. So again we have the inputs for CAPM, so that would allow us to compute K, and then we have some other information that we will be using to obtain the other inputs. All right, so let's first compute the K again from CAPM. This is problem number 2 here. K is again risk-free rate. So let me go back and see what the risk-free rate here is. Risk-free rate is 8%. Market return is 15%. So now this is not the risk premium, this is the market return. So we have to subtract the risk-free rate from this. Beta is 1.2. Okay, so 8% plus 1.2 times 15% minus 8%. Okay, that would be the required rate of return, and that is 16.4%. Right, so that's our K. All right, now it says that Hudson pays 40% of its earnings as dividends, and the earnings next year are expected to be $12 per share. All right, so out of $12 per share, 40% would be paid out as dividend, and so we can compute the next year's dividend. Remember, this is next year's earnings. So earnings are expected to be $12 per share. Out of that, 40% is paid out as dividend. So the dollar amount of dividend would be $4.80 per share. All right, so and again this is D1 because the question says that this is the earnings next year, so that would be E1, right? So we are using E1 and therefore we get D1. All right, and then finally so this is our valuation model, right? So D1 over K minus G. So we have our D1, we just calculated that. We have our K, and the last input that we need here is the required rate of return, that is G. So G is the product of ROE and B, right? ROE times B. ROE is given to us as 20%, right? This is the return on equity. It is our proxy for return on investment the firms makes. And what is B? B is the fraction of earnings that is retained by the company. So part of the earnings might be paid out as dividends, the other part is retained. So B is the fraction, all right? B is not the dollar amount. B is actually the fraction of earnings that is retained. So question says 40% is paid out as dividends. So 40% of the earnings go towards dividends. That means 60% are retained by the company, and therefore B will be 0.6. All right, so ROE is 20%. All right, so let me actually first write down these inputs here. ROE is 20%, that is given in the question, and B is 60%. And why is B 60%? Since dividend payout is 40%, right? So if 40% is paid as dividends, then 60% is retained, right? So 0.20 times 0.60, that would be our growth rate. So that would be 12%. All right, 12% is our growth rate. Okay, and once we have the growth rate, then we have all the inputs that we need for our first question, that is simply the value, right? What is the value of Hudson company stock? So value is D1 over K minus G. We already have our D1, and the other inputs 16.4% minus 12%, right? So D1 over K minus G, that would be the value, and as you can see here, that calculation gives you 109.09. Okay, so that's the first part. The second part is what is the present value of growth opportunities, right? What is PVGO? So let me direct you to the PVGO discussion on slide. So this is where we talked about PVGO. So the total value of the company, the total price can be broken down into two components. E1 over K is the no growth component. So this is assuming that if the company paid out all of its earnings as dividends, what would be the value? So that would be E1 over K, and then the extra that is being paid out is the PVGO. All right, so we can actually use this equation for our calculation. We already have P0 from part A, right? We just calculated that P0. P0 is the value, so that is 109.09. So we have this P0, we have E1. E1 is given to us in the question. It says that earnings next year are expected to be $12 per share, right? So that is our E1, and K is the required rate of return, and we calculated that as 16.4%. So we have P0, we have E1, and we have K. So from this equation we can calculate the present value of growth opportunities. Okay, so P0 is 109.09, and our right hand side is E1 over K. So E1 is $12, K is 0.164, right? 16.4%. So E1 over K, and then plus PVGO, present value of growth opportunities. Right, so here you just have to do this calculation to get our PVGO. So the no growth value here is E1 over K, and that number is let's see, that number is 73.17. Okay, 73.17 plus PVGO, and so your PVGO would be 109.09 minus 73.17, and that is the present value of growth opportunities. So 35.92. Okay, 35.92. Okay, so that's the second part here, part B, and then the last part is what is the price to earnings ratio. And anytime, as I said during the lecture, when we are talking about PE ratio, we are talking about P0 over E1, right? So this is like forward earnings. It's based on next year's earnings. Okay, and in this case, actually it's pretty straightforward because we have our P0. We calculated that in part A. We have the value, and we are actually given E1 in the question, right? E1 is $12 per share, next year's earnings. So this is simply a matter of taking the ratio of those two, and our PE ratio is then 9.09. You can also verify that if you were to use the formula for this, like 1 minus B over K minus G, right? 1 minus B over K minus G. Remember, this is G. So we talked about this last time. PVGO is 1 minus B over K minus G. So then we can actually use that formula as well, and you can verify that that would be also 9.09. So 1 minus B, let me do that here actually. 1 minus 0.60, so that is 1 minus B, right, over K minus G. So K is 16.4% minus 12%, right, and that would also give you 9.09. Okay, so that is your PE ratio. Okay. All right, let's look at the last problem here. So the last question is asking you to compute the market value of equity based on the discounted cash flow valuation. So here is the question. You have the current free cash flow to the firm, so that is FCFF 0, right? Let's actually write down all the inputs that we have here. Current, so this is problem 3. FCFF 0, right? Current free cash flow to the firm. It is 198 million, right? 198 million, and then we have the interest expense as 15 million. So interest expense is 15 million. Then we have tax rate of 35%, increase in net debt by 20 million. Okay. 20 million, and then tax rate is 35%. All right, so and then we are asked to compute the market value of equity. If FCFE, the free cash flow to equity, grows at 3% forever, and the cost of equity is 14%. Okay, so what we are given is FCFF, and from that, first thing that we need to do is compute FCFE. All right, FCFF 0 is given. FCFE 0 would be the first thing that we would need to calculate. So again, going back to the slides, here is our formula, right, to get FCFE from FCFF, right? FCFF minus after tax interest expense plus increase in debt. So we can use that. So FCFF 198 minus interest expense 15 million times 1 minus 0.35 plus increase in net debts, right? So any new borrowing that is added, and that becomes available to the equity holders, and this will give us FCFE 0, right? And that number is 208.25. Okay, so let's write that down. 208.25. This is in $1 million. Okay, then we need to compute the market value of equity. The assumption is FCFE grows at 3% forever. So this is a constant growth model, right? Constant growth model. So the same idea of constant growth that we use for dividends, we can actually use for FCFE. So when dividends grow at the constant rate forever, our valuation equation is D1 over K minus G. So the only thing different in this case would be that instead of D1, we will have FCFE1, right? FCFE1 time over K minus G, or I can also do FCFE 0 times 1 plus G over K minus G. All right, so instead of dividends, we have the free cash flow to the equity holder. So our valuation, our market value of equity would be FCFE 0 times 1 plus G divided by K minus G. All right, again we are assuming constant growth in free cash flow. So 208.25 is our FCFE 0, growth rate is 3%, so 1.03. K is given to us as 14%. We can calculate that as also from CAPM, and growth rate is again 3%. So that would be the market value of equity, and that number is $1,950 million. Okay, so $1,950 million or 1.95 billion. So that is the market value of equity. This is the market value of equity total. Okay, if you have the number of shares, you can simply divide it by whatever many shares are outstanding to get the per share value, right? So if let's say there are 100 million shares outstanding, you divided this by 100 and you will get the price as $19.50 per share. Okay, so as I've said before, this FCFE based calculation is very similar to the dividend discount model. Instead of discounting dividends, you are discounting the free cash flows in this case, but the basic concept remains the same.